Holy smokes everyone, the stock market correction we've all been waiting for is here. In this video, I'm going to go over exactly why the stock market is falling right now, and we're going to go over specifically what's happening with the Nasdaq and small cap stocks and what this story can tell us everyone. So it's an action-packed day, we've got a lot to cover, so let's not waste any time, let's get straight into it. Okay, so first things first, look at this. The Dow dropped 450 points, the Nasdaq fell 2.8%, and what caused this? The 10-year Treasury yields rose to a 2-year high. And I bring up a chart here, everyone. We can see here that the 10-year US Treasury yield has been absolutely skyrocketing up to 1.87%. And we can see here the S&P 500 fell 1.84% as well. Now, something else that is also contributing to this is before the dollar was weakening, but the dollar has been bouncing back from a low of 94.6%. It's rallied all the way back up to 95.8%. Now, why we have to pay attention to the dollar is because all assets are priced in dollars. So when the dollar falls, that's bullish for assets. But when interest rates go up and the dollar goes up, that's bearish for assets, especially commodities. Look at this everyone, Nasdaq confidence slumps towards correction after 2 months without a record. And Bank of America did a report and net tech allocation is at its lowest levels since the 2008 crisis. But what have we been talking about in the channel everyone? I've been saying a lot of stocks are already in a bear market or have already crashed 50%, and it's just a matter of time before the large cap stocks start selling off and bringing the indexes down. For example, look at this. This is the Russell 2000 index. This is a small cap index that makes up 2,000 of the smallest cap companies. And we can see it fell 3% today, and it's also down nearly 15% over the past year. So like in all market downturns, it starts with the smaller, weaker companies, but then it slowly starts to spread to the stronger companies. Now, also a major level was breached in the Nasdaq today. Today, it actually fell below its 200-day moving average. And for those that don't know, simply if you're above the 200-day moving average, it's pretty bullish for stocks. But once stocks fall below the 200-day moving average, that's a bearish indicator. Also, this is what's spooking the markets everyone. Oil hit 7-year high as tight supply bites. And I bring up a chart here, we can now see Brent crude oil has hit $88, and many analysts are saying we're going to see triple-digit $100 barrels soon. And the reason this is bad for stocks is because the Federal Reserve is continuing to say, don't worry, inflation will go away. And with prices going up like oil, and I'll get into in a moment, wages going up, it's showing that inflation isn't going away anytime soon. So what that's going to mean is a more aggressive taper and a more aggressive interest rate hike cycle from the Federal Reserve. And this is why high interest rates hurt growth tech stocks. Interest rates typically hurt growth pockets of the market that rely on low rates to borrow for investing in innovation. Further, their future earnings look less attractive when rates are spiking. So that's for those of you that don't know why high interest rates affect growth stocks so much. And also we got an earnings report from Goldman Sachs, and something that hit their profit margins is higher wages. And Goldman Sachs is saying that higher wages isn't just there for the lower income jobs, but they're also seeing strong wage inflation for banking jobs as well. And while wages going up is good for workers, the Federal Reserve gets worried about this because wage inflation is very hard to stop. You can't just all of a sudden give someone a pay cut like oil going down or other commodities going down. But again, it's not just interest rates going up, it's at the pace they're going up. The market simply wasn't expecting 10-year Treasury yields to be spiking this soon. It's this rapid pace and it's this rapid acceleration in interest rates that is worrying the markets. But it's not just this everyone. The recent Omicron outbreak is weakening consumer sentiment. Retail sales were down 1.9% in December. And this is creating a perfect storm where the Federal Reserve is lifting interest rates into a weakening economy, but they can't reverse course like they did before because inflation is so high. And Jerome Powell said in a recent Senate Banking Committee, if they tighten monetary policy too quick or go too hard, they may have to go into recession to bring inflation down. And listen to this report from Morgan Stanley everyone, this is very interesting. Leading Tuesday's slump were again software and internet companies that have yet to make any money. A Morgan Stanley basket of profitless tech companies tumbled 4.2%, extending its loss from a November peak to more than 40%. And I guess that's only where Cathie Wood has been investing, with a fund down now over 50%. So what you're probably wanting to know is, what does this mean for you and me? Well, what this simply means is interest rates are going up. That hurts companies' growth and earning potential and makes future earnings less valuable. Inflation is not going away. We're going to see the Federal Reserve have to accelerate their taper and have to start selling off assets on their balance sheet, and they're going to have to start lifting interest rates faster and more than they expected. And with the latest economic data, this couldn't be happening at a worse time with the economy weakening. But what you're probably wanting to know is, will it get worse? And people, it all depends. It all depends on what the Federal Reserve will do. Will it sacrifice the economy to bring down inflation? Or does the Federal Reserve do a 180 and do a U-turn once the stock market starts really plummeting, say 20%? Either way, everyone, it is a lose-lose situation for the Federal Reserve. They are cornered. Either they go and fight inflation and bring down the economy, or they start stimulating the economy again and let inflation rise higher and higher and make inequality worse and make the cost of living more and more burdensome for the average American and continue to destroy people's purchasing power. So everyone, that was a quick update of why stocks are falling right now. How much do you think we're going to fall in 2022? Let me know. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you in the next video.